When people first encounter Biltmore Estate, they usually see scale before they see logic. 175,000 square feet, more than 250 rooms, a private village, hidden in the mountains of North Carolina. On the surface, Biltmore looks like a monument to excess, a personal fantasy built by one of America's richest families at the height of the Gilded Age. But that interpretation is incomplete. Biltmore was never meant to be just a mansion. It was designed as a financial organism, a system, a long-term economic structure intended to preserve, project, and reproduce wealth across generations. To understand how Biltmore really made money, we first have to understand the moment that made such a structure seem not only possible, but rational. In the late 19th century, America was experiencing an unprecedented concentration of capital. Railroads stitched the continent together. Industrial monopolies extracted value at scale. Financial markets matured faster than regulatory systems could restrain them. For a small group of families, wealth was no longer measured in annual income, but in structural dominance. George Washington Vanderbilt, too, inherited access to this world rather than wealth in isolation. The Vanderbilt fortune was built on transportation networks, logistical control, and financial leverage. Railroads did not simply generate profits. They generated predictability. They created steady cash flows that could be forecast decades into the future. That predictability made long-term investments not just safe, but strategically advantageous. Biltmore was conceived inside this mindset. The estate was not planned as a city townhouse or seasonal retreat. It was designed as a self-contained economic environment. Land acquisition began years before construction. Thousands of acres were purchased not for aesthetics alone, but for control. Timber, agriculture, water, labor, and transportation access were all integrated into a single domain. This was wealth thinking at scale. At the time, large estates were not viewed as financial burdens. They were seen as stabilizers. In an era of volatile markets and political uncertainty, physical land represented permanence. Owning a vast estate meant insulating capital from speculation while anchoring it in productive assets. The mansion at the center was only the visible core of a much larger system. Biltmore was intended to sit at the intersection of prestige and productivity. Prestige mattered more than modern. Observers often realize, in elite economic circles, prestige was not vanity. It was leverage. It created social gravity. It attracted political access, business relationships, and cultural authority. Hosting power within one's own controlled environment allowed informal negotiations to occur far from public scrutiny. The estate became a stage on which influence could be exercised quietly and repeatedly. But prestige alone does not pay staff, maintain infrastructure, or sustain scale. That is where the deeper economic logic of Biltmore begins to reveal itself. The estate was designed to function as a managed landscape. Agriculture was modernized. Forestry was scientifically planned. Unlike many European aristocratic estates that relied on tradition, Biltmore adopted efficiency. George Vanderbilt hired experts, not stewards. Forestry management at Biltmore would later become a model for sustainable timber operations in the United States. The land was not ornamental. It was productive. This mattered because labor costs were enormous. Hundreds of workers were required to operate the house, the grounds, and the surrounding infrastructure. Food production, heating, repairs, and logistics all demanded constant expenditure. The assumption was not that the mansion would consume wealth indefinitely, but that the estate would partially offset its own costs through controlled output. In this way, Biltmore represented a hybrid model. It combined aristocratic scale with industrial logic. It attempted to transform elite living into a system that could justify itself economically over time. The optimism behind this model was not irrational. During the Gilded Age, wealth accumulation appeared linear. Industries expanded. Markets grew. Capital seemed to reproduce itself naturally if properly positioned. The idea that such a system could one day fail felt distant, almost irrelevant. What mattered was continuity. Biltmore was built with generational thinking. Its materials, layout, and land holdings reflected a belief that the Vanderbilt presence would extend indefinitely into the future. This was not about return on investment in a conventional sense. It was about preserving dominance across time. The estate was a form of capital storage, social signaling, and operational control merged into a single structure. At the moment of its completion, the model appeared sound. The Vanderbilt fortune was vast. The American economy was expanding. Labor was cheap relative to capital. Regulation was minimal. Taxation was light. The world that produced Biltmore rewarded scale rather than efficiency. Bigger was not a liability. It was proof of strength. Yet hidden within this confidence was a quiet assumption that the conditions which made Biltmore possible would persist long enough for the system to sustain itself. That assumption would eventually prove fatal. But before we can understand why the model failed, we must first examine precisely how the money behind Biltmore was generated in the first place, and why it seemed so reliable for so long. To understand how Biltmore was sustained, we must step away from the mansion itself and look outward toward the systems that fed it. Biltmore did not generate wealth in isolation. It was financed by one of the most powerful economic engines of 19th century America: transportation monopoly and industrial capital. The Vanderbilt fortune originated in movement. Cornelius Vanderbilt built his empire not by producing goods, but by controlling how goods moved. Steamboats, shipping routes, and eventually railroads formed a network that captured value at every stage of distribution. This was not speculative wealth. It was infrastructural wealth. Once established, it produced cash flow with remarkable consistency. Railroads, in particular, transformed money into something predictable. They did not rely on seasonal demand or consumer preference. They relied on necessity. Raw materials had to move. People had to travel. Cities depended on supply chains that could not function without rail access. Whoever controlled those rails controlled time, pricing, and access. By the time George Vanderbilt began planning Biltmore, the family's railroad interests had already matured into a system capable of generating steady surplus. That surplus did not need to be reinvested aggressively to grow. It needed to be positioned strategically to preserve influence and stability. Biltmore was one such position. Unlike speculative investments, land ownership offered insulation. Vast tracts of rural land were inexpensive relative to industrial capital, yet they provided something markets could not: permanence. The Vanderbilt approach was to convert liquid wealth into immovable assets that could anchor family power while remaining economically productive. This conversion mattered because industrial wealth was volatile. Markets fluctuated. Competition intensified. Public sentiment toward monopolies hardened. By placing wealth into land and controlled estates, elite families reduced exposure to financial shocks while maintaining the appearance of continuity. But the money that sustained Biltmore did not arrive as a single stream. It flowed from multiple sources simultaneously. Trust distributions provided baseline funding. Returns from railroad holdings covered major operating expenses. Investment income from diversified financial assets absorbed fluctuations. Together, these streams formed a layered structure that allowed the estate to operate without immediate pressure to justify itself economically. In practical terms, this meant that Biltmore did not need to be profitable in a narrow sense. It needed to be manageable. As long as external income streams remained strong, the estate could function as a long-term capital sink without threatening the family's financial position. This is where many modern interpretations fall short. Biltmore was not expected to pay for itself in isolation. It was expected to exist within a larger web of wealth that made its costs acceptable. Yet this logic still required internal discipline. George Vanderbilt approached estate management with a mindset influenced by industrial efficiency. He recruited experts rather than relying on inherited tradition. Agricultural operations were modernized. Forestry was organized according to scientific principles. Timber harvesting was regulated to ensure long-term yield, rather than short-term extraction. These choices were not ideological. They were economic. Labor was abundant and relatively inexpensive during this period. Managing hundreds of workers did not yet impose the regulatory or financial burden it would in later decades. Wages were low. Benefits were minimal. Turnover was manageable. The estate could operate at scale without triggering unsustainable cost growth. The surrounding land functioned as both buffer and resource. Farming reduced dependency on external suppliers. Timber generated controlled income. Water systems supported both aesthetics and infrastructure. Every acre served a purpose beyond appearance. Even social functions played an economic role. Hosting events was not merely a display of wealth. It reinforced relationships that protected the Vanderbilt business network. Influence generated opportunities. Opportunities reinforced revenue. The estate acted as a social amplifier for financial power. This layered approach allowed Biltmore to exist as a hybrid entity, part residence, part enterprise, part symbol. Its costs were high, but they were spread across systems capable of absorbing them. At this stage, the model appeared resilient. The Vanderbilt wealth machine was still operating efficiently. Industrial expansion continued. Labor dynamics favored capital. Regulation remained limited. There was no immediate signal that the balance sustaining Biltmore was unstable. However, beneath this apparent stability lay a structural vulnerability. The estate's survival depended not on its own output, but on the continued dominance of external income sources. As long as railroads remained untouchable and capital concentration persisted, Biltmore could exist comfortably. The moment those conditions began to shift, the logic holding the estate together would come under pressure. Before that pressure became visible, Biltmore entered its most ambitious phase, the attempt to transform scale into permanence and permanence into control. Once the funding sources behind Biltmore were secured, the next challenge was scale. A mansion of this magnitude could not function like a conventional residence. It required constant coordination, predictable systems, and long-term planning. Without structure, its size would have turned from advantage into chaos almost immediately. Biltmore was therefore designed not as a house, but as an integrated economic environment. At the center sat the main residence, but around it unfolded a carefully managed ecosystem. Roads, villages, farms, workshops, and forests were not secondary features. They were essential components of a system intended to reduce dependency on outside markets while keeping costs controllable. This was a critical distinction. Most elite homes of the era relied heavily on external supply chains. Food, fuel, materials, and labor flowed inward continuously. Biltmore attempted to reverse that relationship. Wherever possible, inputs were generated internally. Dairy farms supplied food. Gardens reduced procurement costs. Timber from the estate fed construction and maintenance needs. Even brickmaking and carpentry were managed on site. The economic logic was simple. Every unit of production that could be controlled internally reduced exposure to price fluctuations elsewhere. Stability mattered more than maximum profit. Biltmore was built to endure, not to optimize quarterly returns. Labor organization reflected the same philosophy. Rather than employing purely seasonal or informal labor, the estate supported a semi-permanent workforce. Workers lived on or near the property. Housing was provided. This created a predictable labor pool that could be trained, monitored, and retained. While costly up front, this arrangement reduced turnover and operational uncertainty. From a financial perspective, Biltmore functioned like a vertically integrated firm. Inputs, processing, and outputs were concentrated within a defined boundary. The estate was large enough to justify specialization, but controlled enough to maintain oversight. Forestry management provides one of the clearest examples of this approach. Instead of harvesting timber aggressively, Biltmore implemented a system of rotational cutting and long-term planning. The goal was sustained yield, not immediate revenue. This mirrored industrial practices in sectors that prioritize continuity over extraction. Forests became assets with projected lifespans, not consumable resources. This mattered because land was not viewed as static. It was treated as capital. Agricultural experimentation further reinforced this mindset. New crop techniques were tested. Soil management was studied. Efficiency was measured. These practices were not romantic gestures toward rural life. They were economic strategies designed to make the estate partially self-supporting. Prestige, too, was systematized. Hosting guests was expensive, but it was also strategic. Biltmore provided a controlled environment where relationships could be cultivated away from public scrutiny. Political figures, industrial leaders, and cultural elites were brought into a setting that subtly reinforced the Vanderbilt position. Influence was exercised through hospitality, not confrontation. This social capital translated indirectly into economic security. Access protected assets. Relationships smoothed regulatory pressure. Visibility reinforced legitimacy. The mansion itself became a tool in a broader financial strategy. At this stage, Biltmore represented the ideal expression of elite economic thinking of its time. Scale was coordinated. Resources were integrated. Costs were understood and, crucially, absorbed by a wider financial structure. Yet this very integration masked an emerging fragility. The estate's complexity required constant oversight. Its systems were tightly coupled. Small changes in labor cost, regulation, or taxation could ripple outward, amplifying pressure across the entire structure. What made Biltmore efficient under stable conditions made it vulnerable under change. The mansion did not fail because it lacked planning. It failed because it was optimized for a world that was already beginning to disappear. To understand where the cracks first appeared, we need to examine the costs that grew quietly in the background, long before any visible collapse occurred. The financial strain that eventually undermined Biltmore did not arrive suddenly. It accumulated quietly, year after year, embedded in systems that once appeared efficient. These costs were not obvious from the outside, and they were rarely discussed publicly, yet they were relentless. The first pressure point was labor. Biltmore's scale required a permanent workforce numbering in the hundreds. Housekeepers, gardeners, foresters, farmers, craftsmen, engineers, drivers, cooks, and administrators were all essential to daily operation. In the early years, this labor was relatively inexpensive. Wages were low, protections were minimal, and expectations favored employers. But labor economics never remained static. As the 20th century progressed, wages began to rise. Labor organization strengthened. Expectations around working conditions shifted. What had once been manageable staffing costs grew steadily, even as the estate's productivity remained largely fixed. Unlike a factory, Biltmore could not increase output to offset higher labor expenses. Its size was already maxed. The estate became cost-heavy in a way that offered no path to scaling efficiency. Maintenance imposed a second, equally persistent burden. Every room, corridor, roofline, and mechanical system demanded constant attention. Heating alone required vast quantities of fuel. Plumbing systems aged. Electrical systems required upgrades. Stonework eroded. Wood warped. None of these expenses were optional, and none of them generated revenue. Large estates suffer from a unique economic problem. Maintenance scales faster than usefulness. The larger the structure, the more surface area degrades, and the more labor is required simply to prevent decay. These costs do not fluctuate with market conditions. They persist regardless of economic climate. Biltmore's design magnified this effect. Its architectural complexity, once a symbol of mastery, became a source of financial drag. Decorative features that had served prestige now demanded specialized upkeep. The estate's beauty carried a recurring price. Energy costs added another layer of strain. Heating such a vast interior Space was not merely expensive, it was structurally inefficient. Early systems were fuel-intensive and labor-dependent. Even incremental increases in fuel prices had outsized effects on operating budgets. Efficiency gains were limited by the building's original design, which prioritized grandeur over conservation. At the same time, agricultural self-sufficiency began to erode. As national supply chains improved, internal production lost its comparative advantage. Buying food and materials externally often became cheaper than producing them on-site. What had once been a strength turned into redundancy. Maintaining farms and workshops for symbolic or marginal benefit no longer made economic sense, yet dismantling them created social and logistical complications. Then came taxation. The introduction and expansion of income taxes, property taxes, and estate taxes fundamentally altered the calculus of elite wealth. Large estates, once lightly taxed, became visible targets for public revenue. Valuation increased. Assessments rose. Fixed assets suddenly carried ongoing financial obligations that could not be deferred. For families accustomed to private arrangements and minimal oversight, this shift was profound. Liquidity became an issue. Biltmore was rich in assets, but poor in flexibility. Its value was locked into land and structures that could not be easily sold without dismantling the very system they supported. When external income streams weakened, the estate could not compensate internally. Costs continued regardless of revenue. Performance. This mismatch between fixed costs and declining flexibility created tension. Prestige, once an asset, began to lose its economic function. Social influence no longer guaranteed. Protection from taxation or regulation. The informal networks that had once shielded elite wealth became less effective in a more bureaucratic state. Gradually, the logic that had justified Biltmore's existence began to fracture. The estate still stood, still impressed, still symbolized an era of power. But financially, it had become brittle. The danger was no longer excess. It was rigidity. And when systems optimize for stability and counter structural change, they do not adapt gracefully. They crack. To see how these hidden pressures converged into a breaking point, we now need to examine the economic shifts that made Biltmore's model untenable. Every economic model has a threshold beyond which adaptation becomes impossible. For Biltmore, that threshold was not a single event, but a convergence of changes that transformed the environment it depended on. What had once been manageable pressure turned into systemic strain. The first major shift was structural. Taxation. By the early 20th century, wealth in the United States became increasingly visible to the state. Income taxes, estate taxes, and property assessments expanded in both scope and enforcement. Large, immobile assets like Biltmore were no longer symbols of private autonomy. They were measurable, taxable entities. This altered the economics of scale. A mansion of Biltmore's size could not shrink to reduce its exposure. Its valuation remained high regardless of how much revenue it generated. Taxes became a recurring cost untethered from performance. Even in years of weaker income, obligations remained fixed. At the same time, the Vanderbilt family's external income sources began to face pressure. Railroad dominance eroded as regulation increased and competition intensified. Government oversight reduced pricing power. Labor disputes disrupted operations. Returns, once steady and predictable, became less certain. The financial cushion that had absorbed Biltmore's costs thinned. This created a dangerous asymmetry. The estate's expenses were rigid, but the income supporting them was increasingly volatile. A system designed for predictability was now exposed to fluctuation without the ability to respond internally. Social expectations also shifted. Public sentiment toward extreme wealth hardened. The Gilded Age model of visible excess lost legitimacy in a world grappling with inequality, war, and economic disruption. What had once been admired began to invite scrutiny. Maintaining such an estate became politically and socially uncomfortable rather than advantageous. Prestige stopped functioning as protection. Operationally, Biltmore faced an innovation trap. Modern efficiency upgrades required significant capital investment, yet offered limited savings due to the building's original design. Retrofitting was expensive and disruptive. Doing nothing was equally costly. The estate was caught between preservation and adaptation, unable to fully commit to either. Then came broader economic shocks. Market downturns and periods of financial contraction exposed the estate's lack of resilience. During times when capital tightened, liquidity mattered more than assets. Biltmore had value, but not flexibility. Selling portions of land or infrastructure weakened the very system the estate relied on. The logic of ownership began to invert. What had once centralized power now concentrated risk. Every square foot added obligation. Every acre carried tax exposure. The estate no longer amplified wealth, it absorbed it. This was the breaking point, not because Biltmore failed dramatically, but because it became economically unjustifiable. The rationale that once supported its scale no longer aligned with reality. The mansion had been built for a world where capital favored permanence, control, and insulation. That world had moved on. From this point forward, the question was no longer how to sustain Biltmore as a private estate, but how to prevent it from becoming an unsustainable liability. To understand how power turned into burden and how ownership itself became the problem, we need to examine the final phase of the mansion's transformation. Once the economic logic supporting Biltmore weakened, ownership itself became the central problem. The estate did not collapse in flames or scandal. It simply stopped making sense as a private asset. What had once concentrated power now concentrated cost, exposure, and responsibility. The shift was subtle but irreversible. Biltmore's size, which had once insulated the Vanderbilt family from uncertainty, now magnified every financial challenge. Maintenance costs continued regardless of occupancy. Taxes accrued, independent of profitability. Labor requirements remained fixed even as the estate's strategic value diminished. The mansion no longer served as a lever of influence. It became a drain on flexibility. This transformation revealed a fundamental weakness in the mansion-based wealth model: scale without adaptability. Unlike financial assets, Biltmore could not be restructured quickly. It cannot be divided without losing coherence. It cannot be downsized without eroding its identity. Selling it outright would have meant abandoning not just property, but legacy. The estate was trapped between symbolism and solvency. At this stage, the logic of preservation replaced the logic of dominance. The question shifted from, what does this estate give us, to how do we keep it from consuming us? That change in mindset marked the true end of the original model. The mansion no longer functioned as capital. It functioned as obligation. Externalization became the only viable path forward. Parts of the estate were gradually repurposed. Land was sold or leased. Operations were restructured to reduce loss rather than generate profit. Eventually, Biltmore transitioned toward public access, tourism, and institutional management. The estate did not disappear, but it changed hands conceptually. It moved from private power to managed heritage. This transition was not failure in the dramatic sense. It was adaptation under constraint. Yet even adaptation came with trade-offs. Opening the estate to the public introduced new costs: compliance, staffing, preservation standards, and marketing. Revenue became dependent on visitor demand rather than structural dominance. The mansion entered a service economy, a far cry from the industrial wealth system that had once sustained it. What remained was a shell of the original intent. Biltmore still stood as a symbol of ambition and craftsmanship, but its economic role had fundamentally shifted. It no longer multiplied wealth. It required justification. Its survival depended on constant management rather than inherited power. This final phase exposes the core truth of the mansion economy. Extreme assets built for permanence are vulnerable in systems that reward flexibility. When economic conditions change, size becomes inertia. Ownership becomes exposure. Biltmore survived not because the original model endured, but because it was abandoned. To understand why this transition was not unique to Biltmore, and why the mansion-based wealth model cannot return in modern capitalism, we need to step back and examine the broader system that replaced it. When we step back from Biltmore and view it not as a landmark, but as a system, its story becomes less about excess and more about timing. The estate did not fail because it was poorly conceived. It failed because it was built for an economic environment that no longer exists. The mansion economy was a product of a specific alignment of forces. Capital was concentrated. Labor was cheap. Regulation was minimal. Land was abundant. Wealth flowed from monopolistic structures that favored scale over efficiency. Under those conditions, extreme estates made sense. They stored capital, projected power, and reinforced dominance across generations. Modern capitalism operates on different principles. Today, flexibility outweighs permanence. Liquidity matters more than land. Influence is exercised through networks, platforms, and financial instruments rather than physical presence. Assets that cannot adapt quickly are exposed. Costs that cannot be adjusted become liabilities. Size without optionality is no longer a strength. This is why modern wealth rarely manifests as private. Mega-estates. Contemporary elites favor portfolios over monuments. They allocate capital across markets rather than locking it into immovable structures. Real estate is treated as one asset class among many, not the foundation of identity or power. Prestige has migrated from ownership to access, from permanence to reach. The lesson of Biltmore is not that wealth inevitably collapses, but that wealth models age. Systems optimized for one era become fragile in the next. The very features that once made them dominant turn into sources of rigidity. What cannot bend must eventually break or be repurposed beyond recognition. Biltmore survives today because it abandoned the original logic that created it. It no longer functions as a private wealth engine. It exists as managed heritage, sustained by public engagement and institutional oversight. Its endurance is real, but its purpose has changed completely. This transformation is the final chapter of the mansion economy. Extreme wealth once expressed itself through land, labor, and stone. Today, it expresses itself through abstraction, mobility, and control of systems rather than space. The mansion, as a model of power, belongs to the past. Understanding this shift matters because the same pattern repeats across history. Assets built for dominance can become burdens when conditions change. Structures that feel permanent are often the least adaptable. Wealth that looks unassailable can erode quietly when its logic no longer fits the world around it. The mansion economy did not collapse overnight. It expired slowly as relevance faded and costs remained. And that may be the most important lesson of all. If you want to continue exploring how money builds power and why even the strongest systems eventually fail, consider subscribing to the Mansion Economy and joining us for the next documentary.